So there's three companies right now that I think have massive upside potential, minimal downside potential, and how I'm going to use them to scale my $1.2 million account in 2026. We're going to walk through the good, the bad, the ugly, and how to capitalize, what option strategy to use, how many shares to buy, all that good stuff. We're going to break down in this video right here. Okay, so company number one with a lot of upside potential and not a lot of downside potential, in my opinion, is going to be NVIDIA. Now, if we look at the chart, how much is this bad boy up in the last 5 years? You can see right here, 1,200%. You're going to be like, Brandon, I already missed the move. It's 185 bucks per share. How much more can this company really go up? And as you guys know by watching this channel, the number one thing that moves a price in the stock of a long term is what the earnings per share, what the profits are doing. So if we take a look at what NVIDIA's profits are doing and what the earnings per share is doing, it is very obvious and very clear why this company is going up and why it's likely to continue to keep going up. Look at the revenue growth right here. Revenue growth since 2022, clearly up and to the right. Revenue started to explode, EPS started to explode, going up also. It's no surprise that in that same time frame, the stock started to explode too. Because again, EPS goes up, revenue goes up, the stock price is going to follow that. Now, simply looking at those two things right there, it's not enough for us to say, hey, we were bullish on NVIDIA. What we have to do is take this one step further and understand the valuation level of NVIDIA. So I have a chart right here of the price earnings ratio level, and you can see going all the way back until 2023, till right now, you could clearly see that the price earnings ratio level has been going down. Basically what that means is the company is now on sale, it is now cheaper than what it was before, and earnings per share is continuing to grow year after year after year. So you're getting a strong company with a strong moat, with good pricing power, with a durable competitive advantage, and you're okay to hold this company for the long term. Those are all things that I'm looking for to figure out, hey, do I want to allocate money to this company? So I think that NVIDIA is relatively compelling right now. Now, if we take a look at this chart, let me give you a little bit of a price prediction for where I think NVIDIA is going to go in the next few years, because I do think that it's actually going to blow your mind. So this line right here corresponds to the earnings per share growth of NVIDIA in the last couple years. I do expect this earnings per share growth to continue. As you can see right here, I'm basically just plotting this line right here of earnings per share going up. As EPS goes up, the stock is likely to follow that. So we take a look at this. Take a look at where I'm at on the chart. We're going all the way out until mid-year of 2027. That's where I did this, roughly a year and a half out from right now. NVIDIA stock very likely could be somewhere around 250 bucks per share. Right now it is $185 per share. Is the stock just going to go follow this line and go straight up and to the right? Of course not. There's going to be a lot of volatility along the way, but when you understand that profits are clearly going up and to the right, the stock is eventually going to follow that in the long term. So I am very bullish on NVIDIA. Now, really quick, like the bad things about NVIDIA of what could potentially happen. Number one, maybe the hyperscalers come out and say, hey, we're going to spend less money on capital expenditures. We need less AI chips. Maybe there's a DeepSeek 2.0 moment or something like that where there's just less spending out there for chips. That would definitely be bearish for NVIDIA. In my opinion, what you're getting versus what you're paying, I think that NVIDIA is fundamentally attractive right now, and I think that the growth is strong. The fact that their profit margins are like 75% and expected to get better, that shows that if they want to raise their prices, they can, and that's why, like an iPhone, for example, the profit margins are so fat because they have a very durable moat. They have a good company that there's not a lot of competition out there. So that is why I like NVIDIA right now, and I'm personally allocating. So what trades am I doing? Let's just go back and take a look at the chart. So when I feel like NVIDIA is trading below intrinsic value, which I do think it's a little bit below intrinsic value or pretty much right at it, just like the true value of where the company should be at, I will sell puts, I will buy calls, and I will buy shares. And that is exactly what I'm doing in my portfolio right now. Actually, to make this even better, I'll just show you inside this account to show you what trades I have on NVIDIA right now. Okay, so take a look at how I'm allocated right now. You can see that I sold 10 NVIDIA puts right here, bought 6 call options here, and bought 2 call options right here. So I sold these puts and I collected $25,000 immediately in my account by selling these puts. You guys know by watching all my other videos, I sell portfolio secured puts. I'm not sitting on cash to secure this trade. Like if this was a cash secured put, you would have to have $145,000 in cash sitting there doing nothing. Instead, I have some of that money in shares. Instead, I have some of that money in my base portfolio working for me. So that is why portfolio secured puts are better in the long term, because you could have your money working for you and still have the ability to sell puts at the same time. So these are some of the trades that I have on NVIDIA right now. You can see my expiration dates go way out. That is the name of the game in the investing world. You can see that earnings per share, again, is up and to the right. And when you understand that, the stock is going to follow that in the long term. On a quarter to quarter basis, I don't know what Nvidia is going to do, but I know that if earnings per share is going up like this and I get it at a solid valuation level to start, it's likely that I'm going to make a lot of money on that company because you bought a good company at a good price and you're patient and gave it time to grow. As earnings per share goes up and to the right, the stock is going to be like a magnet above and below this line right here. Okay, company number 2 is going to be Meta. How much is this bad boy up in the last 5 years? Right around there, 132% in 5 years as Meta stock. You can see we recently had a pretty big drop right here on the stock, but in my opinion, it is very compelling to allocate right now. If we take a look at what the profits of Meta are doing, you can see Meta going up and to the right here. Revenue is going up and to the right. Let me move myself right here so you can see it a little bit better. So good revenue growth, good profit growth. And the thing that you have to understand is that Meta right now is spending so much money on capital expenditures for AI data center build out. The main reason why the stock fell is because investors are like, oh my God, you're spending all this money. How are you ever going to generate an ROI on that spending? I do think they're going to generate an ROI. And when that capital expenditure starts to slow down, where's that money going to go? It's going to go right here to earnings per share. So even though they're continuing to grow earnings per share right now when all this CapEx is happening, what happens when CapEx slows down, and what happens when the data centers that they're building out are going to monetize and start making them money? It is a double bullish catalyst in my opinion. So when you understand that, you understand that fundamentally speaking, if we look at Meta, this is a 10-year chart of the price earnings ratio level. They started out at 45 times for the P ratio. Now you can see right now they're at 22 times, which is pretty darn compelling if you ask me, given the growth of revenue and earnings per share that is expected to come. I think that Meta has a moat. I think that they have pricing power. I think if you want to do advertising online, they pretty much control the entire space. Yes, there are a few competitors, but it's like their reach is so big, billions and billions of people. I like the company. Okay, so if we take a look at Meta's chart, I already plotted the earnings per share growth line in the last few years, and I took it all the way out until, we'll just say July of 2027. I already did all the math on the back end for this. So when you understand that as earnings per share is going up and to the right, which is also correlated right here, earnings per share is going up and to the right. Yes, it is not a perfect straight line, but I'm taking the average of this growth rate here and I'm plotting it on this chart right here. So you understand that, you'll realize, oh my God, Meta was very, very undervalued right here. Maybe Meta was a little bit expensive up here, but now maybe it's a little bit cheap. So as you understand the stocks go above and below this growth line in the long term, I have a mid-2027 price target on Meta for somewhere around $800 per share. Right now we're at $616 per share. That could indicate quite a bit of upside. Let me just draw this out for you right here. That is roughly 30% upside in Meta right there, which is pretty darn good. And if you capitalize in the right way with options, you could obviously magnify that return right there. So what trades am I thinking about doing on Meta right now? And honestly, like I'm already allocated to Meta, but it's going to be similar to Nvidia. Buy shares, sell portfolio secure puts, long duration, and take some of that cash flow to buy more shares and take some of that cash flow to buy some leap call options too. Because again, if you do short duration option contracts, you're not really going to capitalize on earnings per share going up and to the right. And you're also not really going to capitalize on, hey, the stock is a little bit below intrinsic value right here. We need it to go rebound to where it should actually be trading at. Like in this entire time frame right here, like the stock was below intrinsic value through here because it's below the earnings per share growth line, but it's like monthly call options aren't going to capitalize on the stock rebounding back to that. The sentiment was very bad. Sometimes this stuff takes time. So if you would have bought a 2-year call option right here and just say that you went from March 14th of 2022 to we'll just go to March 14th of 2024, I mean, you could see like you would have captured a big move right there. But if you would have did a short duration option strategy, your timing just has to be so much more precise. It's just way harder to actually scale this in the long term. So that's why when good companies go on sale, I allocate long duration on that, generate fat premium when I go sell these long duration portfolio secured puts, and then I go reinvest it back into the company. All of my ratios are in check. Even if the market were to fall 50%, I always set my ratios in check. So it's like I'm still going to be protected in that situation right there. So that is Meta. The earnings per share looks good. The revenue growth looks good. I think that when investors start to price out all of this bearish news about capital expenditures, I think that the stock is going to rebound. And actually, just to show you this here, we could go to capital expenditures here and you could see just how much it really is. Because I'm not going to lie, it is a lot. You could see that for 2026, it's estimated to be $121 billion. But what is the 2026 revenue? $272 billion. So it's like it's definitely a sizable percent of their total revenue. But as that capital expenditure starts to slow down, it's going to get realized in the bottom line of earnings per share, and I do think that the stock is going to go up. I honestly think the stock's going to be higher than $800 by mid 2027, but I'm giving you my conservative estimate right here. So I'm allocating to Meta also, and I have similar plays as what I have on Nvidia for Meta also too. And if you want to take a look at the Charles Schwab account, this is what I currently have open on Meta right now. And by the way, this is just accurate to the time of recording this video. This stuff changes sometimes if I want to reallocate or readjust something. This is what I did. So I sold 5 contracts, sold puts, 560 strike for 2028, and I collected $46,000 in premium the second that I did this trade. Went to the cash balance of my account, took that money, and reinvested it. Bought these shares right here that I recently just bought. And then I have these call options right here too. So you can see that everything is longer duration. Like these option contracts go to 2028 and the shares don't have an expiration date, so I could hold them forever. So what is likely to happen is that these sold puts are going to expire worthless. I don't anticipate I'm going to have to hold them all the way until the end. So I'm essentially going to get these shares for free, and I could hold those shares forever and keep making money even though the trade is done. And then these call options will probably do pretty well too. I know that there's going to be a lot of volatility along the way. I'm not expecting to make $1 bazillion in one quarter. Like we're going to have to hold this for a little bit of time to make a lot of money. And if we go back to the chart, you just understand that this earnings per share growth line going up and to the right, we know that the stock is going to follow this in the long term. It's almost like a 100% accurate indicator that the stocks are going to follow where the profits go in the long term. Just look that up yourself. So it's like getting in at a good valuation level, there's your margin of safety. Selling long duration puts, that's a margin of safety because my strike price is all the way down over here at $600. Meanwhile, look at the distance between where that's at and where the profits are expected to be. So that builds a lot of margin of safety into the trade that I have right there. Now, let's go into the last company, which is a company that is extremely beat up in share price that I do honestly think if the one bad thing about it gets resolved, I think that the stock is going to absolutely explode. So going back to the charts, let's dive into number 3, and maybe you're cheating and looking, but it's going to be Adobe. 5-year chart. Let me get myself out of the way. I'm always in the way wherever I'm at. 5-year chart, you can see that this bad boy is down a lot. All the way down here, minus 38%, which is honestly insane. Because if we go look at the fundamentals for this company, it's like earnings per share is going up and to the right. The revenue is going up and to the right. So why is the stock going down? And it's all coming down to one single thing. The one single thing is that everybody is all worked up that AI is going to take market share from Adobe. Customers are going to go switch and go somewhere else. And when that happens, their margins are going to compress. Their pricing power is going to be bad. The revenue is going to go down. EPS is going to go down. But what we're seeing right now, you can see how consistent their revenue growth is, how consistent their earnings per share growth is. When you understand that the vast majority of this business has their revenue coming from recurring revenue like monthly subscriptions and stuff like that, that is why it is so smooth and so consistent of a line. And if you notice right now, this is something very important that most people aren't actually looking at. The hollow line right here, the hollow circle right here is where the earnings per share estimates are versus where they're actually coming in at. So as the typical analyst, retail investor, institutional investor gets nervous about AI, they're thinking like, what does this actually mean for a company like Adobe? So they're thinking like, oh, this could be bad for Adobe. I think it's going to be bad. So then we're going to revise our earnings estimates down. So there's the earnings estimates going down right here, but they're just continuing to beat those estimates because it's just the steady, consistent line up and to the right because of all of this consistent, recurring revenue and stuff like that. So analysts are nervous. That's shown in the estimates right here, but Adobe continues to beat the numbers. So there's like a huge discrepancy here between revenue and earnings per share going up and to the right, but yet the stock keeps falling. And if you just look at the price earnings ratio on this company, this is a 5-year chart, it's honestly insane. It started out in 2021 at 41 times earnings, and right now it's literally at 12 times earnings. So what that's saying is you are getting way more profits for each dollar of share that you buy. So the ratio points to this company is very undervalued right now. And I do think there's a lot of room for this stock to explode. And if we go and zoom out a little bit, you could see that this stock goes through boom and bust cycles. And, I'm not a big technical guy, as you know, but it's getting close to this bottom right here, September 1st of 2022 of $281 per share. Right now it's at $292. I'm not saying that it's going to bottom and just go straight up from there, but look at this explosive move that the stock did after this huge blow off top right here. Look at this huge pump. The stock went up 125%. So the move right now, in my opinion, is to realize that this company is undervalued, assuming that we think the mode is going to be fine and AI is not going to crush this business. If we understand all that, I think that we're going to do okay. Now, this company has a lot of recurring revenue. So the profits in a 5-year period, let me draw this line for you. It's going to be honestly really insane, but the profits are literally going like this, up and to the right. So when you understand that, you're like, look at my humongous margin of safety that I have right now, buying into this company and allocating in a long duration way. It is very compelling right now. So what I'm personally doing, I'm not allocated to Adobe yet. I've been debating allocating through this time frame right here. Then it did a little bit of a pump, so I wanted to wait because I wanted to get it a little bit cheaper. It is now in my buy category right now. This company is just so compelling and so obvious that it just makes sense to allocate right now. That's what I'm getting at. So again, buying shares, selling long duration puts, and buying call options, I think is going to be the move for Adobe. Now, always have your ratios in check. Never go too hard into one single company just in case we are wrong. I'm not going to make money on every single trade, but on balance, I do beat the S&P 500 since before COVID, and I have this channel in the Discord talking about my historical ROI, and I show this stuff live on some of my other YouTube videos. Guys, I've been smoking the market since before COVID with the system that I do right here. So also this thing in my Discord called the stock sheet. This is where I break down a lot of corporate data, the valuation, the growth, the moat, execution, risk, sentiment, macro, all that good stuff. And I put it on a scorecard of the companies that I'm most bullish on. I do economic reports, bull bear scales, assignment value, IV sheet, all that good stuff. Calculators, there's a lot of good stuff that I factor in to really know if I want to buy a company or not. It's not as simple as looking at Nvidia and saying, oh, the numbers look good, I want to buy it. I want to know what the hyperscalers are saying. I want to know what AMD is doing. I want to know what Broadcom's doing. I want to know what SMCI is doing. I want to know how the labor market's doing. I want to know the entire picture of the whole macro thesis before I go and allocate to these companies. Because if the S&P 500 is a bubble and if the labor market's crapping to bed, like I don't want to allocate to really anything at that point, because if the S&P falls, it's going to bring everything down with it. So there's a lot of things that I factor in to these plays right here before I go actually allocate and take on, the risk of trying to make money on it. But when you do all your research and really understand the whole picture right there, you're likely to do good in the long term. Okay, so that being said, if you are patient with these 3 companies, I think that you could make a lot of money with it. Of course, nothing is guaranteed. I'm allocating. I'm going to be patient. I get it. There's going to be a lot of volatility, but we will revisit this video in 2 years and see what happens. That being said, check out the pinned comment if you want to learn more about my system. If not, watch this video right here. I broke down the 5 most popular option strategies and show you that only one of them worked. Check it out right here. I'll see ya.